Bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly account for sales returns. So if you're unfamiliar to the accounting process with sales returns, don't fret gang, I dropped the link to get you up to speed in no time. So with that being said, let's get it. So it tells us to journalize the following sales transactions for Thomas Sportswear. Explanations are not required. The company estimates sales return at the end of each month. And so we have some information here. It said Thomas sold $21,000 of sportswear for cash. Cost of goods sold was $10,000. And Thomas received $6,000 sales return on damaged goods from the customer on July 1st. Cost of goods damaged was $3,000. Okay gang, so a quick recap about inventory. We know that inventory is an asset once it's purchased, but the moment that it becomes sold, an expense is created called cost of goods sold. We also understand that there are always two sides of inventory when it comes to a merchandising company, the selling side and the purchasing side. In this particular situation, we are accounting for the sales side. More importantly, a sales return. So here's the deal, gang. At the end of each period, when it's time to do the adjusted entries, companies will estimate the amount of expected returns that a customer may bring back in the following period. Thus, two accounts will become affected in terms of an estimate. One, a refunds payable account, which happens to be a liability, and two, an estimated inventory received account, which happens to be an asset. Both of those particular accounts are mere estimates, gang, and will be adjusted in the actual circumstances that returns are being made. And so in reference to the actual sales return, we always have two independent transactions that must be accounted for. One, to account for the actual refund that involves the cash portion, and two, to account for the inventory that is actually being received, gang. Now remember, companies aren't in the business of selling inventory at cost. Therefore, we will simultaneously always have two numbers to account for. But in terms of the refund, it's going to be based on the sales revenue, gang. However, we know that inventory is on the books at cost. So when it's time to make the second entry that involves returning the inventory back, we must use the cost amount, gang. So with that being said, let's attack the problem. So it tells us Thomas sold $21,000 of men's sportswear for cash. Cost of goods sold is $10,000. All right, gang. So this is a sale. And first we have to identify the actual revenue part. So we're going to take that big amount, the $21,000, and account for that. Since it's for cash, we're going to debit cash. And we're going to credit sales revenue, gang, for the $21,000. We're going to check our answer. Fantastic. Next, we must account for the actual inventory that's sold. And we know that an expenses arise every time we sell inventory called cost of goods sold. Thus, we're going to create that expense by debiting cost of goods sold, and we're going to credit merchandise inventory at cost of the $10,000. We're going to check our answer. Excellent job. Now it tells us that Thomas received $6,000 sales return on damaged goods from the customer, and the cost of those damaged goods are $3,000. All right, gang, as I mentioned earlier, we have two transactions that must be accounted for. First, we're going to account for the actual refund. Therefore, we're going to debit refund payable for the $6,000, and we're going to credit cash, gang, because we're giving them their money back for the $6,000. We're going to check the answer. Good job. Now we have to account for the inventory that was actually returned. Now remember what I said earlier, gang. At the end of the previous period, we make an estimate for the inventory that is expected to be returned. And one of those accounts that is affected is the estimated return inventory. So in this particular transaction, since we are having a return, that account will now become affected. Therefore, we're going to reduce our previously recorded estimated inventory return account and increase our inventory on the books. So we're going to debit inventory and credit estimated returns inventory at cost of the $3,000. We're going to check our answer. Well done, gang. So there you have it. A quick, easy illustration of how to properly account for sales returns. So if that light bulb was clicking, which I know it did, please like, subscribe, and share the channel with your friends so they can chase the bags as well. As always, gang, I'm Dr. Who, and it's my humble pleasure for you guys to be here with me, and I'll see you soon. Bags!